Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Indian Accounting Standard 23, which deals with borrowing cost. Borrowing cost is what? Borrowing cost is that cost. Means if a company acquire any loan for the purpose of investing that amount for the acquisition, production and construction of qualifying asset, then that cost is to be capitalized with the respective qualifying asset. So in this standard we generally discuss about the borrowing cost, which is of capitalized in nature. Means that cost is required to be capitalized with the qualifying asset. And this standard generally deals with asset of the company. Means it's an asset based standard. So let's start our topic. Before we start, what we will generally discuss in this standard, we have make a brief of that. Content in these standards are, firstly we will discuss about the main principles of these standard. Then what are the scope criteria in these standard, that this standard is applicable on what kind of transactions and not applicable on what kind of transactions. Then eligibility of borrowing cost, whether the specific borrowings are there, what are their measurement principles, and general borrowing, if there is a general borrowing, then what are the measurement principles, then how we will recognize these borrowings in our books, what are the recognition criteria of the borrowing cost, then period of capitalization, when should we start capitalizing this cost with the qualifying asset, that is the date of commencement, when we will start the capitalization. Suspension means for the time being it will be suspended, temporary suspension or permanent suspension. Cessation means when we stop the capitalization, when we will stop the capitalization of this cost to the cost of asset. So this is the period when we will start capitalization, during the process of capitalization, and when we will stop the capitalization. This is discussed. And then the disclosure, how we will disclose in the financial statement, what disclosure is required to be given. And then we will discuss about the difference between the Ind AS 23 and Accounting Standard 16. So let's start. Firstly, we will discuss about the main principles of these standards. It says that the cost, the borrowing cost, which is directly attributable to acquisition and construction and production of qualifying asset, is required to be capitalized as a cost of asset. Borrowing means taking loan from external party, from bank, from debenture is kind of borrowing. If it term loan is a kind of borrowing. Borrowing cost is that cost which is taken from bank, from external party, and which is directly attributable to the acquisition, construction and production of qualifying asset. Qualifying asset, what do you mean by qualifying asset? Qualifying is that asset that takes a substantial period of time to get ready for its intended use or sale. Means any asset which takes certain period, means a substantial period of time to get ready for its intended use or sale, then that asset is to be treated as a qualifying asset. And if any cost incurred for acquisition, construction and production of that qualifying asset is to be capitalized with that cost of asset. Now qualifying asset is the asset when the asset is not ready for use. Means when the asset is not ready for use or sale, is which takes substantial period of time to get ready for its intended use and sale. The intended use and sale means the intention of the management is to be seen whether the asset is required for the use of the management, or the asset is required for the purpose of the sale. What was the intention of the management? So this is explained by example. Suppose a company is acquiring any land, and which is its purpose is to construct a building. So intention of the management is to construct a building and then to sell that flats. So that is the intention of the management, to sell the flats. And if the purpose of the management is to use that asset for its personal use, then also it's a qualifying asset. So intention is to be for office purpose it is used. And substantial period of time means it generally substantial period of time is not defined in Ind AS 23. The management has taken an assumption that substantial period of time means 12 months. 12 months or more. But in AS 16 it is defined that substantial period of time, the definition of substantial period is given, that is 12 months. But in Ind AS 23 is silent about this, does not define the definition of substantial period of time. So management has to take decision according to terms and policy, according to the requirement. They will take 3 months, 6 months, they will consider accordingly. But in general they will assume that the substantial period of time will be 12 months or more. So this is the definition of qualifying asset, and the example will be any property, plant, equipment, investment property during the process of construction, means they are incomplete asset. They are WIP asset, not ready for use. That kind of assets are treated as a qualifying asset, on which some processing is required for the purpose to get ready for its intended use or sale. Means qualifying asset is the incomplete asset, the asset which is not completed yet, the asset which is in WIP condition, which requires some time to get ready for its intended use. That asset is to be treated as a qualifying asset. And intangible asset during the development process. In the process of development, whatever assets are there, they are treated as intangible assets are there, they are treated as a qualifying asset. And made to order inventories. Made to order inventories means, I am taking the example of a car. Suppose the Tata Motors business is to make a car in a large quantity and on repetitive basis. But there are some companies, EMT, that is Executive Mod Car Trends, which are located in Mumbai. That is EMT company are making a car on customized basis. That is also an inventory for them. But that inventory they will not make in large quantities and on repetitive nature. They may prepare that car on order basis. Means they customize the car according to the specification given by the customer. So any inventories are on order basis, made to order inventories, that inventories is treated as a qualifying asset. Means inventories are not treated as a qualifying asset, but made to order inventories are treated as a qualifying asset. And any intangible asset during the process of development, that is also treated as an intangible qualifying assets. And PPE and investment property during the construction period, which is of incomplete nature or in WIP stage, then that asset is also treated as a qualifying asset. Suppose we are explaining by example, XYZ Limited has taken a loan for purchasing a land. They had purchased a land and loan has taken for purchasing that land. And on which the building, they decided to construct a building on that land which is used for office purpose. The intention of the management is to use that land on which building is constructed, and that building is used for office purpose. And time taken for completion of building is 2 years. 2 years is the substantial period of time. Means 1 year is generally, but here time is given, which is assume that it is a substantial period of time to complete the qualifying asset. Here land and building are qualifying asset because the management intention is to use this asset for office purpose, and it takes substantial period of time to complete that asset, and hence any interest cost the company has to pay on that loan is to be capitalized to the respective asset. So this is the concept, the basic concept, basic principle of this standard. Definition of borrowing cost includes borrowing cost, that is interest and other costs for borrowing of any fund. It may include interest expense, then processing fees. Other cost means any processing fees, any transaction cost, any commission paid for acquiring that loan. Then that cost is to be calculated using the effective interest method under Ind AS 109. So borrowing cost includes interest cost and other cost. Other costs are processing cost, transaction cost, commission paid for acquiring that loan. If any commission is paid, that cost is also considered as a borrowing cost. This is to be explained by example. Suppose XYZ Limited has taken a loan of 250 crores for the purpose of construction of factory building at an interest rate of 10%. So company has taken a loan of 250 crores for purpose of the company to take the loan is for construction of a factory building, and the interest rate will be 10%, and processing fees is to be paid is 30 crores, and loan is to be repaid within 1 year, and building is constructed within 6 months of taking loan. So what was the effective interest rate? We have to calculate the effective interest rate firstly, that is total inflow of the company, which is equals to total outflow. So first we will calculate the total inflow. Total inflow in cash is 250 crores, that is loan taken, actual loan taken, minus the transaction cost. Whatever the processing costs are there, we have to reduce from that loan amount. So 220 crores. 220 crores is the inflow of the company, and outflow what the company is required to pay at the end of the year, that is principal plus interest component. Principal is the 250 crores and interest amount is means at the rate 250, interest rate will be 10%, so 25 crores is the interest component. So 250 plus 25, that is 275 crores is the outflow for the company. Now we have to excess payment the company is going to pay, that is 275 crores is the outflow and 220 crores is the inflow. So the differential amount is 55 crores. And effective rate of interest, how they will calculate? The excess payment divided by the total inflow of the company. The excess payment is 55 crores and inflow to the company is 220 crores. So the effective rate of interest will be 25%. Now the interest will be calculated on effective rate of interest. So on 220 crores, whatever the loan amount is there, on which 25% effective rate of interest is to be charged. So 55 crores is the interest component. Now the loan is repayable within 1 year. Interest amount is 55 crores and the building is completed within 6 months of taking loan. So how much amount is to be capitalized to the building? Because it is completed within 6 months, so only 6 months interest component is to be capitalized with the cost of qualifying assets. So cost of 6 months interest will be 55 crores into 6 divided by 12, that is 27.5 crores, and remaining 27.5 crores is to be charged to P&L. So in this way we will explain the example of interest component This is the first definition of borrowing cost, which includes interest expense and processing fees. Then the next is what they include: interest on lease obligation as per Ind AS 1. Suppose if the company has acquired any asset on lease, then they have to pay lease rentals. Lease rentals, because as per Ind AS 116, they had to create a ROU asset and lease obligation. And on lease obligation, whatever the lease rentals they are going to pay, that is to be considered as a lease interest. So that amount is to be capitalized with the respective asset. Suppose A Limited want to construct a factory building. For that he has taken some cranes, some equipments on lease. And lease term of lease is 1 year. As per Ind AS 116, A Limited will create for that asset which the company has taken on lease, they have to create an ROU asset on their books and lease liability, lease obligations as a liability, and the company will charge lease interest on the obligation. Then that interest is taken as a part of borrowing cost, because that equipment which the company has taken, which is directly used for the construction, production or acquisition of a qualifying asset, that expense is also treated as a cost of borrowing cost, and it is to be capitalized with the cost of asset. Then the third one which includes in the borrowing cost are exchange difference arising from foreign currency borrowings, to the extent that they are regarded as an adjustment to the interest cost. Means if a company takes any loan from the foreign banks, then on that loan the exchange difference will arise. Because what was the purpose of taking loan from foreign and not from an Indian market? Because in foreign market the interest rate is low, and in Indian market the interest is rate is high. For that purpose, some of the companies are taking loan from the foreign markets. This is to be explained by example. Suppose on 1st April 2022, A Limited has borrowed a money from US based bank of $200 lakh for the construction of building at an interest rate of 6%. Because US based banks are providing loan at an interest rate of 6%, and the A Limited has borrowed from US based bank $200 lakhs. On that date, the exchange rate on the date of taking loan, the exchange rate will be rupees 64 per dollar. And on 31st March 2023, that is the closing date, the rate of exchange will be rupees 70 per dollar. If the same amount the company has borrowed from Indian market, the effective rate of interest will be 12%. Then how the company will recognize this cost in the books of A Limited? So this is the example, and the illustration will be: first we will determine the amount of borrowing in Indian currency. That is $200 lakh in USD, and in INR the dollar amount is to be converted at say rupees 64 per dollar on the date of transaction. That becomes rupees 12,800 lakh. If we had taken the loan from Indian market, the interest rate will be 12%. Then we will calculate the interest. If it is taken in Indian currency, then the interest will be 1,536 lakhs. And if it is taken in the foreign currency at the rate 66%, then it will be 200 into 6%, that is 12 lakh, and it is to be converted at closing rate, that is 70 per dollar, then it becomes 840 lakhs. If it is taken from the foreign currency, then the interest amount will be rupees 840 lakhs, and if it is taken from Indian market, the rate of interest will be 12%, and then the interest amount will be 1,536 lakhs. So there is a gain. The Indian company has to pay more if they had taken loan from Indian market, and they have to pay less if they had taken loan from foreign market. So the saving of interest due to foreign currency loan is what? How much amount? Interest in Indian currency will be 1,536 lakhs and interest in foreign currency will be rupees 840 lakhs. Saving in interest will be 696 lakhs. This is the saving. But then we will calculate the foreign exchange gain and loss at the end of the year. Because foreign exchange fluctuation rate will be a closing rate, we have to convert in every balance sheet. Outstanding loan is done there, so 200 lakhs is the loan amount. This is to be converted on the closing date, that is 70 minus 64, 1200 lakhs is the foreign exchange gain and loss. That up to that extent, up to the foreign exchange gain and loss, there is a means it's a said that in this concept it is said that adjustment of foreign loss means 1200 lakhs is the loss for the company because they have to pay more, and that is the foreign exchange due to foreign exchange fluctuation. So that adjustment of foreign loss up to the amount of saving in interest, that loss is to be adjusted how much interest the company has saved. So that amount of loss is to be adjusted with the amount of saving in interest. That is, the saving in interest will be 696 lakhs and the loss will be 1200 lakhs. So how much the company will save? Up to 696 lakhs. The loss is to be adjusted and remaining loss is to be charged to P&L as a foreign exchange loss. So means it was said in that the concept is that the company will adjust the foreign loss up to the saving of interest. If the company has incurred, if the company has taken a loan from Indian market, then the company need to pay that interest. But the company has taken from foreign currency, loan from foreign market, the company has actually paid it now. So saving is, and if there is a fluctuation loss, then that loss is to be adjusted with the saving in interest, and that is to be capitalized with the cost of asset of the borrowing. Means actually we will capitalize with the cost of borrowing, that is the 840 lakhs, that is the interest in foreign currency, and 696 lakhs which is we have to save, the foreign loss which we adjust, which is treated as a foreign loss. Means actually we are adjusting as per Indian currency. The interest is to be paid in Indian, that is 1536 lakhs, and remaining foreign loss is to be charged to P&L. And if there is a gain, then there is no adjustment, it is directly credited to the P&L. Then comes what are the scope, what are included in this standard and what are not included. The applicability of this standard is an entity shall apply this standard in accounting for borrowing cost. This standard is applicable on accounting for borrowing cost. It does not apply to actual or imputed cost of equity included, that is including preference share capital not classified as liability. So if the company raise money by issuing equity share capital or doing IPO and that money is utilized for the purpose of construction of asset, its company's own capital, and paid dividend to the shareholders, then that amount is not capitalized with the asset because it's company's own capital is out of the scope of this standard, and preference share capital is also not included. But if the preference share capital is a redeemable preference share capital and treated as a liability, then that redeemable preference share capital is to be, and any dividend paid on that preference share capital or any interest is to be paid on that preference share capital, then that dividend is to be treated as a borrowing cost. But if it is non-redeemable, then it is not treated. And redeemable preference share capital is that capital which is classified as a liability in the books of the company. Then that only is to be and treated as a external loan and on that, if dividend is to be paid by the company, then that dividend is to be treated as a borrowing cost. Now, a qualifying asset measured at fair value, such as biological asset, means it is also not applicable to that asset which is measured at a fair value, means biological asset. Then any inventories that are manufactured or otherwise produced in large quantities or on repetitive basis, means it is not applicable, it is out of this scope of this standard, means it does not applies to equity share capital, it does not applies to biological asset and these and inventories which are manufactured in large quantities and on repetitive basis, which I discussed by example. Suppose Tata Motors prepare a car on a repetitive basis and on in large quantity, then that car is to be treated as an inventory for that, and that and if any Tata Motor has taken loan for producing that car, then the interest which is paid by the Tata Motor is not capitalized with the cost of inventories, and it is to be charged to P&L. But if EMT. EMT means Executive Mod Car Range, Mumbai, has been a business for the longest of the time and has based in the cities like Bangalore, Mumbai, Surat and Coimbatore. Their business is to customize the mobile car, back mobile for the industrialist of Pune, and made Ferrari out of the Toyota Corolla. They made Ferrari out of the Toyota Corolla. So their main business is to made to order car. Their business is to make a customized car on the basis on the specification or description given by the customers. So they does not make and that car is also inventory for EMT train Mumbai. That car is also inventory for them, but they are not preparing their inventories in large quantities on a repetitive nature. They prepare car on customized basis, on customer to customer basis, and for them the car is an inventory, but they does not manufacture car in large quantities and on repetitive basis, because it's a customized car according to the specification given by the customer. And any borrowing cost, if they taken any loan for the production for the customization of that car and pay any interest, then that interest is to be capitalized with the cost of inventory. So that interest is to be capitalized with the cost of inventory, but in case of Tata Motors it will not be capitalized. What was the recognition criteria for the borrowing cost? Means that cost which is to be capitalized, which are directly attributable to the acquisition, construction or production of a qualifying asset as a part of the cost of asset, when there is a probability that the asset will result in a future economic benefits to the entity and the cost can be measured reliably. This is to be explained by example. Suppose a company has taken a loan for construction of a factory building, and due to some reason the government has stopped or banned that factory. Then the loan which is taken, what they will do? Whether the company will capitalize that interest borrowing cost amount to the respective asset which is banned by the government, which is stopped by the government to construct. Due to any reason, legal reason, the government has stopped that construction work. So this is a kind of impairment example also. The asset is impaired. Now there is no use of asset. When there is no future economic benefit, the company does not have any future economic benefit from that asset, then there is a probability that then that cost is not to be recognized in the cost of the asset. Means that loan, that interest amount is to be capitalized, is not to be capitalized with the respective asset, and is to be charged to P&L. when there is because there is no probability that future economic benefit is incurred by the company from that asset, and the cost can also be measured reliably. So if there is no probability that future economic benefit arises from that asset, then the cost of asset to that qualifying asset is to be charged to P&L and not to be capitalized with the respective asset. Only when there is a probability that it will result in the future economic benefit to the entity and the cost can be measured reliably, then only for the cost of the borrowing is to be capitalized with the qualifying asset. And what do you mean by directly attributable cost? Directly attributable means those borrowing costs that would have been avoided if the expenditure on the qualifying asset has not, means the cost which is directly related to the acquisition, construction or production of the qualifying asset, means the loan which is taken for the purpose of the that acquisition, construction and production of the qualifying asset, and that in that interest amount is to be paid on that loan, then that interest amount is directly attributable to that project, that specific project, then that cost is to be treated as a borrowing cost and it should be capital. Measurement principles of a specific borrowing. Specific borrowing means the company has taken a loan for a specific purpose. Suppose company has taken a loan for purchasing a car. Company has taken a loan for purchasing a home. That is, home loan is there, car loan is there. That kind of loan is for specific purpose. The company has specifically taken a loan for infusing that amount in a particular project. That loan is to be taken as a considered as a specific loan, specific borrowings. When the fund are borrowed specifically for the purpose of a particular qualifying asset. For example, home loan is taken, car loan is taken, any loan is taken for specific project, then that loan is to be considered as a specific borrowing. And that cost is also measured as, means the actual cost incurred less any income earned on a temporary investment of such borrowing. Suppose the company has taken a loan of 100 crores and company utilize only 50 crores and the rest amount is to be, the company has invested on fixed deposits for a short term period and earn interest of 10%. So for the time period the company has parked the remaining amount to gain some income. So that amount is to be reduced from the cost of. For example, this is to be explained by example. A Limited on 1st April 2022 borrowed rupees 50 lakhs at an interest rate of 11% to finance the construction of two qualifying assets. The company has constructed a two qualifying asset and the company has borrowed 50 lakhs at an interest rate of 11%. Construction started on 1st April 2022. From the date when the company has borrowed the amount, from that date the construction started. The loan facility was availed and utilized on 1st April 2022. With the remaining fund invested, means the company has utilized some of the amount on 1st April 2022 and the remaining amount is to be invested or parked in a invested in some other on FDs or some temporary investment the company has made on, from where they gain a 7% interest. So on the date on 1st April 2022 the company infused some amount on factory building and office building, that is 15 lakhs. On 1st October 2022 then the company has infused 10 lakhs and 10 lakhs. During that period, that is on 1st April, the company which has utilized 30 lakhs only, remaining 20 lakhs is to be invested at an interest rate of 7%. So what we will, how they calculate on a specific purpose, cost of borrowings, what amount is to be capitalized? That is, firstly they will calculate the interest component is 50 lakhs at the rate 11%, that is 5,50,000. Now in specific purpose, actual cost is means if the company has parked that amount for a temporary period, then that income is to be reduced with the cost of borrowing cost, actual cost. Then firstly we will find the actual cost, that is on 1st April 2022 the borrowing company utilized the amount is 15 lakhs on which the interest paid 11%, that is 1,65,000 in both the cases, factory building and office building. And on 1st October the company has infused the remaining amount, that is 10 lakhs in both the project, and the interest component will be 55,000. The company has incurred some income during that period from 1st April to 1st October, that is the 6 months. The company has parked that amount at a rate of interest of 7%. So company has incurred an amount of 35,000 because it is for the 6 months only. Then it is to be calculated 10 lakhs into 7% for 6 months. That will be 35,000. That interest income is to be reduced with the actual cost of borrowings. So 1,65,000 plus 55,000 minus 35,000, it will be, the borrowing cost will be 1,85,000. That 1,85,000 is to be capitalized with the cost of asset. Cost of asset will be 25 lakhs for factory building and for office building both, and 1,85,000 is the borrowing cost which is to be capitalized with the cost of asset. So the total will be at the end of the year will be 26,85,000. This is the illustration for specific borrowings. If the company has taken loan for specific and suppose if the specific purpose of the borrowing is completed, is met, and some amount left and not repaid by the company, then that amount is to be treated as a general borrowings. General borrowings means taken a borrowing from different sources, make a pool of borrowings and then invested in a particular project, 2-3 projects. So means company has borrowed from ICI Bank, company has borrowed from debentures, company has borrowed nationalized bank, international bank, and then they make a pool of that. They had taken a loan from different sources and then they had invested in a particular project. Suppose the company has borrowed 500 crores and then they invested 100 crores in one project, 250 crores in other second project. In this way the company, this is managed by the treasury team, how they will recognize in their books. If the company has taken a loan for general purpose means when a company borrow amount from different sources and make a pool of it, and from there the company utilize the amount for a particular project, then they will measure by applying capitalization rate to the expenditure on that asset. How they will calculate the capitalization rate? Total interest amount divided by total loan amount excluding the specific borrowings. Specific borrowings is not taken into consideration for calculation of capitalization rate. This is to be explained by example. Suppose XYZ Limited borrow fund from different sources in order to infuse that amount on different projects. Suppose amount borrowed 8% debenture, that is 15 lakhs, 10% term loan from ICI Bank, that is 30 lakhs, 9% loan from HSBC, 18 lakhs, 6% loan from PNB, 17. And in this case, if there is a specific borrowings, like if there is a HSBC bank, this is a specific borrowing for the purchase of car, that loan is taken for the purchase of car or home loan, then that specific borrowing is not taken into consideration for calculation of capitalization rate. In that case, we will exclude 18 lakhs from 80 lakhs. But in our example, there is no such specific borrowing. So we will take in the whole amount as a general borrowings. Company has spent rupees 50 lakhs for construction of one of the project. One of his project, the company has taken a loan of 80 lakhs and company has utilized 50 lakhs. So how they will calculate? Firstly, they will calculate the weighted average rate of interest. So they will calculate 8% debenture, 15 lakh is the loan amount, and they will calculate interest thereon, that is 15 lakhs into 8% for the whole year, it will be 1,20,000. In the same way, they will calculate for the 10% term loan, 9% loan from HSBC, 6% term loan, that is on 30 lakhs, they will calculate 10%, on 18 lakhs, they will calculate 9%, and 17 lakhs calculate 6%. So, the total amount of interest will be 6,84,000 and the total loan amount will be 80 lakhs. So weighted average rate of interest will be 6,84,000 divided by total loan amount, which give rate of weighted average rate of interest will be 9%. That 9%, from that 9% we will calculate the amount spent on the qualifying asset. Means the amount spent on qualifying asset is 50 lakhs, and on that the interest component will be at the rate weighted average rate, that is cost of borrowing equals to amount spent on qualifying asset into weighted average rate of interest. That is 50 lakhs into 9%, which give rise to 4,50,000 is to be capitalized with the cost of qualifying asset. But if there is a specific borrowing, then we will reduce that amount. We will not take into consideration. Now, date on which capitalization of borrowing commence means the date when the company will start capitalizing the borrowing cost. When the company will start the capitalization of borrowing cost to the qualifying asset. Borrowing cost should be capitalized on the cost of asset on the commencement date. On the commencement date means commencement date for the capitalization is the date when the entity meets the following condition. Borrowing cost incurred means borrowing when the company incur the borrowing cost, that date means when the loan is to be taken. Expenditure for the asset is incurred, the date when expenditure on that asset is to be incurred means any payment made for the purchase of that asset, any transfer of asset to acquire another asset means the company has transferred one asset and acquire another asset, that and incur any expenditure on acquiring that asset. Interest bearing liability means company has taken a low asset on lease basis, on credit basis, and paid interest. That interest bearing liabilities, the date on which the company bear an interest means the company has taken an asset on credit basis, and the grant received from government. If the company has received any grant from the government, then that grant is reduced from the cost of the asset. So expenditure for the date on which the grant received from the government, which is reduced from the cost of the asset. The date when the company has make a payment for the purchase of asset, the date when the company has transferred one asset and acquired another asset, and the company has acquired any asset on credit basis. So that if any expenditure for the asset is incurred, that date is also taken into consideration. And if the company has made the date on which any activity has been started to prepare the asset for its intended use or sale. The company has made any activity that are necessary to prepare the asset for its intended use or sale, then that activity is also taken into consideration for determining the commencement date. Means the company has to check the borrowing cost incurred date, the date when the company has taken a loan, the date when the company has incurred any expenditure for the assets, and the date when the company has started any activity to prepare that asset for its intended use or sale. Activities means technical or administrative work. Any technical work company has done, or any administrative work company has started. Suppose company has making any project and taken a license for that, taken a graphs or project designing, started a project designing, means prior to the commencement of any physical construction, any step the company has taken, any step for any paperwork company has started Any activity company has started for preparing that asset for its intended use or sale means technical or administrative work prior to the commencement of physical construction. Suppose a company has taken a loan on 1st April 2022. The company has purchased an asset on 1st October 2022. Means the company has taken a loan, borrowing cost incurred on 1st April 2022, purchase incurred an expenditure on asset is on 1st October 2022 and started an activity on 1st January 2023. Then the company will take 1st January 2023 is the date of the commencement when the three condition is satisfied. Means the company has already taken a loan, purchased an asset and started activity. Means any activity the company has started prior to the physical construction, that activity. That is, company has started activity on 1st January 2023, then that is to be taken as a date of commencement for capitalization of the borrowing cost. Now, suspension or deferment of capitalization means postponement of capitalization. Capitalization of borrowing cost shall be suspended during the extended period in which it suspends active development of the qualifying asset. This is to be explained by example. During the COVID scenario, the construction of all the company who has constructed a real estate business or road or bridges, they had stopped their working. All the business has stopped working. That time the company has, if the company has borrowed any loan, that is not to be capitalized with the respective qualifying asset during that suspension period. If the company has not worked for 1 year because due to COVID scenario, then that 1 year interest is to be charged to P&L and not to be capitalized with the qualifying asset, and it should be charged to P&L. That is to be said, the cost shall be suspended. That cost shall be suspended during the extended period, not to be capitalized with the cost of asset. It should be suspended and charged to P&L because there is no active development of that qualifying asset, because the active development is suspended for that period. In some other cases, there is another concept, that is capitalization of borrowing cost shall not be suspended due to temporary delay, as it is necessary part of the process of getting an asset ready for its intended use or sale. Means some of the borrowing costs are not suspended because that cost is incurred on a regular basis. That suspension is on incurred on a due to geographical calamities, due to geographical reason, due to natural purpose. Then that suspension is not taken into consideration. Suppose project stopped due to any requirements of any material or requirements of any fund, then that project is stopped for a temporary period due to some legal purpose. The project is stopped, then that suspension is not treated as deferment of capitalization, and they will remain, that cost is to be remain capitalized with the respective qualifying assets. This is to be explained by example. Suppose capitalization continues during the extended period, because this is this temporary delay is unavoidable. That is, the company does not do anything for that. Suppose there is a delay in paperwork or delay in acquiring any material, delay in acquiring any fund, then that delay is the part of the necessary part of the process of the company. So that is not to be, for that the company will not suspend the capitalization process. So they will continue to capitalize that amount to the respective qualifier. Now, cessation of capitalization, that is stopping of capitalization. That is first the commencement, then deferment or postponement of capitalization, and then the cessation, when the company will stop the capitalization process. when all necessary activities to prepare the qualifying asset for its intended use or sale is substantially completed, then the capitalization on that asset is stopped, and from that date the borrowing cost is to be charged to P&L, which means the activity which is necessary to prepare that asset for its intended use and purpose, intended use or sale, substantially completed means more or less it is almost completed, it is ready for use, but some touch up is there, some means 95-99% it is completed, only 1% is left, that is without that only the company will able to use that product or sell that product. That is some building is constructed ready for sale, ready for use, but some painting work is left to do or some interior work is left to do, without that only the company will able to use that asset. So that asset is to be taken into consideration. That time the company will stop capitalizing the borrowing cost, and after that the company will charge to P&L. When an entity completes the construction of a qualifying asset in part, and each part is capable of being used independently, while the construction continues on other part, the entity shall cease capitalizing borrowing cost when it completes substantially all the activities necessary to prepare that part for its intended use or sale. This is to be explained by example. Suppose a company has made a project on which 3 buildings they are prepared. One is for residential building, another is for commercial building, and third is for suppose some hospitals or some clinics they are preparing, or some amusements, entertainment parks and all. And if the one project, that is residential building, is completed, but the commercial building and amusement park which they are preparing is not completed, then the company will stop capitalizing the cost to the residential building because it is completed partly, and the partly asset is independently used, is being capable of independently used, and other assets remain to be capitalized. When entity completes the construction of a qualifying asset in part, and each part is capable of being independently used, while the construction on other parts, the entity shall cease capitalizing, means those the completed part on which the company cease to capitalize the borrowing cost, and the other on the other part the company remain capitalizing the cost of borrowings. So this is the concept of cessation of capitalization, that is stopping the capitalization. And then disclosure. How the company will disclose these transactions in the financial statement, what was the disclosure requirement, the amount of borrowing cost capitalized during the period, what amount they will capitalized as a borrowing cost, and capitalization rate used, what rate of capitalization they will reuse. This is the disclosure. And then the difference between Ind AS 23 and AS 16. What was the difference? There is a key difference between Ind AS or IAS 23 and Ind AS 16. AS 16. AS 16 generally deals with borrowing cost, that is the old accounting standard, and Ind AS 23 is the new accounting standard as per IFRS or as per IAS, which also deals with borrowing cost. Means borrowing cost in Ind AS terms it will be Ind AS 23, and in old accounting standard it will under AS 16. Now the scope criteria, AS 16 does not provide any relaxation related to scope, means does not give any relaxation the biological assets and inventories, but Ind AS 23 or IS 23 does not applicable to the qualifying asset measured at fair value, that is biological asset and inventories that are manufactured or otherwise produced in large quantity on a repetitive basis. Now substantial period of time defined under AS 16, but there is this substantial period of time is not defined under Ind AS 23. It is taken an assumption, that is it is assumed that 12 months is taken into consideration as a substantial period of time. Now, effective rate of interest. Effective rate of interest is the calculation method. The reference for a calculation of effective rate of interest is given in Ind AS 23, but it is not given under AS 16. Effective rate for calculation is not given under accounting standard 16. Now, disclosure criteria. Capitalization rate used to determine the amount of borrowing cost need to be disclosed. Previously, in accounting standard 16, no such disclosure is required, but in Ind AS 23, rate of capitalization is also required to be disclosed. Thanking you for watching my video. Please share, like and subscribe my channel.